This happens to be the very first interview that I'm doing for this channel. So welcome to Morgan Cashflow Pro. Yeah, you are the first.
Sounds good.
Hopefully we'll be able to provide some value to people out there who are either in the market for shopping for a mortgage or even considering HELOCs, which I'm sure you've seen some of my videos, we deal with HELOCs a lot. It's one of the nicest tools that we've identified as working for dynamic banking. We're here to talk about mortgage information. Specifically, what brought us here was PMI. We had a discussion after one of my recent videos.
Yep.
Discussing HELOCs, right?
Yeah.
So
HELOCs typically don't have PMI. So
yeah. So there was a couple of caution things we were talking about, and I said, hey, why don't we get on Zoom and do a video, and we can talk about a few different things that people should look out for when they're doing mortgages. So do me a favor, introduce yourself and your background with the mortgage industry so people can know why should they listen to you.
Yeah.
What's your credentials here?
Yeah. Hi, I'm James Vanderzanden. I work in the mortgage industry. I'm obviously not here representing anything about my employer, so there's all my legal disclosure there. I've spent about 8.5 years working in mortgage servicing, and now I work in regulatory compliance, and I spend a lot of time with mortgage servicing. So it's kind of like those things bleed over.
Can you summarize briefly what topics are we going to go over in this that people can look forward to?
What the heck is PMI, and how do I get rid of it? Because nobody wants it on their own loan. Right.
Yeah, I have PMI on my loan. Definitely. Well, I'm actually looking at refinancing right now to get out of that. So
yeah, so, there are other ways.
I was happy to have this conversation and what things to look out
for.
But,
yeah, because you'll want to look at your disclosures, because PMI, it's from this law from the 1900s, 1998, the Homeowners Protection Act, placed limits on PMI and basically limited what a lender could do, and then prescribed certain instances that a borrower has the right to say, I want to get rid of it. I meet the criteria. Right. Get rid of it. So I just, it's kind of like, what can I share with James, that might be helpful. I was helping a buddy, shop for houses, and he had a realtor, and the realtor was like, oh yeah, and then you just get rid of PMI. I'm like, being someone that worked in servicing, I'm like, you don't just get rid of PMI. That's like the ideal situation, right, is to just get rid of it. But there are situations where you might not have the ability to cancel it, like if it's like an investment property or multi-unit property. But operationally, most servicers are going to have a planned way out, because they don't want to have you just refinance away to get rid of PMI.
Right.
But the law that's written was the Homeowners Protection Act back in 1998, and it's good. It's better than nothing, but boy, does it suck, and everybody hates it.
Yeah. Yeah, they definitely made some changes, so we can talk about it.
Yeah. I mean, most of the changes that have happened have been in the investor level, like Fannie and Freddie, but that's them just providing exceptions, not really changing the fundamental rule for all homeowners. What I effectively have that I can cover is just sort of the coverage, the scope of what the law covers is the single family primary residence loan. So if you are buying a house and it's a rental property, you're going to have to look at your disclosures, and your disclosures will tell you this is when PMI is going to go away. Here's what you're going to have to do to cancel it. And so they'll have some of those things. They won't have every investor guideline written out, but they'll have a lot of contact us from the legal requirements.
Right.
There's effectively 3 ways PMI can be removed from a loan. One is automatic. So when your loan is on the date your loan was originally scheduled to reach, 78% loan to value, that's on that date, then it's just automatically going to come off. And it's original schedule. So it's if you pay down faster, it doesn't accelerate that automatic drop off. You still have to have you still have to be current on your payments, basically.
Right.
The second method is you pay it down, you have a good payment history. which is for like last 2 years, like no 60-day lates, and then for the last year, no 30-day lates. And then you have to the lender may require you, and that's what's in the law, that they can require you to provide certification that there are no subordinate liens and that the value hasn't declined. They're going to do that through them, so don't just go get an appraisal and send it in, because your lender won't typically use that. And then the third way is like this exception method. And, I think you're a realtor, so you understand. People say the value of my house has gone up. Boy, have I made improvements. Well, the law doesn't cover that. But most of the GSEs or whatever, they created a way out. And they said, well, based on, we'll do a current appraisal, you do it through your servicer, they'll order it, you pay for it, and then they'll send somebody out, they'll look at the house or whatever it is, whatever method they use for that valuation. And then based on the loan to value threshold they've set for that exception, that'll determine whether PMI is removed. It doesn't change any of the other dates, but it's a way out. Like if you've, replaced a lot of things around the house or done a lot of work, there's a lot of work that, that doesn't really increase the value.
Yeah. And is there some cases where they won't, it has to be 80% of what you originally paid for it in order to get the PMI off?
Well, the value that they use under the law is the lower of the original appraisal or the sales price. So like if you buy a $400,000 house and you buy it for $300,000, well, as that's
80%
like,
of the 300.
what the market produces, it's 80% of whatever the lower those two is. If it's a refi, it's just typically going to be the appraised value.
Right.
And so you're going to know that number. Like the first thing to do is look at those disclosures. They're going to give you the cancellation date, or if it's an ARM loan, you'll get a follow-up that tells you once they've calculated that date. And then put it on a Post-it note. What's the date that I can request it to come off? And what's the balance, which you can request it for the loan for PMI to come off on your principal residence, single family home at 80%. Once you paid down to 80%.
Yeah.
Or on the date you were scheduled to reach there, which it's kind of weird to imagine a loan where you're above 80%, but you're on that date, but you can. So like the first thing to do would be to figure out those numbers, put them on a Post-it note, just attach it to your computer monitor would be, the old way to do it, or put a note in your phone, and then just check diligently. Your servicer is going to have to tell you, like every year, they're going to send you an annual disclosure. So like, it's not like you're in the dark, but because of that window of that, 80% versus 78 automatic termination, that can be a fair amount of time for people. And so like the sooner you remove it, like it's gone. And you could look at the savings, like, if you're really close, you might say, do I want to risk paying $2,000 down on principal to save myself, $60 PMI? Well, we can do the math, and, principal you were going to pay anyway, so like, but if it's something like pay $30,000, you might say, gosh, that sucks.
Yeah.
And, in the old days, there are ways that people will try to, there's loans that are structured to try to not have PMI, like VA loans, they have like the funding fee, and FHA loans, they have that insurance kind of built in. When I bought my first house in fall of 2007, we had probably the last 80-20 loan in Oregon, which is where it's an 80% first, a 20% second, and we paid like the closing costs. Most lenders aren't going to do that. They want PMI because it makes them feel safe, because it insures the lender. Sure. And so it means like, what do you get for PMI?
Takes all the risk off of them, right?
It takes some of the risk off, because they're still like, they don't fully. I don't know that anyone fully insures a loan that way, but it's typically like, if you would approve 80, you might insure like up to 90 or 95. So that
so the mortgage insurance just covers a portion of the loan.
Mm-hmm. Yeah, it's a portion of the loan, whatever makes the lender comfortable. Basically.
Okay. So it might only insure 17% of the loan then, if they're putting 3% down, and 80% is a typical, or 20% is a typical down payment.
Yeah.
So the lender would normally be an 80. The PMI is going to cover 17,000.
Right. Or whatever it is. So it's whatever that agreement is. I mean, you never see that money once you pay it. So, And then in some cases you can deduct it from your taxes depending on the will. There's a will they, won't they. They do pretty much every time.
Right.
There's a tax law of is PMI deductible this year, and you pretty much just have to look
I guess
at the.
That begs the question: where is the value in PMI never dropping off? Then, if it's not insuring all that much money, why would they make that change to where you're going to pay on it for your whole loan for FHA loans now?
PMI advantages the lender. Where it advantages the borrower is you're basically paying for an insurance policy in lieu of bringing in whatever the down payment would be to not have it. So it's like, it's really tough when talking with people that are in that situation, because like they've already bought the house and they're like, now I want to get rid of this thing. And it's like, well, the benefit you have is the fact that you have the house. You didn't have to spend that money before. Right. and so it ends up like, some people can feel really trapped, especially like when there's a market decline, or if you have the nicest house in the neighborhood and it doesn't like reflect that in the value.
Right.
So it's just something to be aware of. It is not an automatic gone. Like there are points where it might be depending on your situation, and your disclosures will have it. Your mortgage servicer will have it. Like, I highly recommend like making sure you're aware of those things. Even at the beginning of the loan, call the servicer, just ask them like, are there any ways I can get rid of this? With the mortgage servicing rules that came out, following the Dodd-Frank Act, it kind of scared a lot of lenders. I'm not speaking for any lender in particular, but they go, there's a lot of rules with closed-end mortgages. HELOCs, they didn't really add as many rules too.
Yeah, they're still pretty loose.
They're still a moving target. They still have some pretty strict rules. They still have like there's still a variable, like there can still be promotions. They, some of them have a repayment phase and a balloon, and there's all those things, but like,
it's a heck of a lot easier to get them than a regular loan. Well, it depends on your equity,
typically
but the paperwork is not this thick.
Yeah.
Paperwork for my HELOC, I think my paperwork was about that thick, and for my home it was like that thick.
Right. Yeah. You have a lot more disclosures for the closed-end loan, and there's a lot more requirements. I mean, there's like,
and timing-wise, it was like a month to do the home loan or a regular mortgage, and about 2 weeks to do a HELOC, right?
Yeah. I mean, before some of the newer requirements, I remember, I think the fastest I'd ever heard in the industry was someone closing on a loan in 5 days.
Yeah.
But that's like, with you don't need an appraisal. You're like sailing right through.
Was that in the middle of the ninja loans? No income, no job?
This was near the same time, but this wasn't one of those. So
okay.
Probably one of those. It might be a little quicker. Some guy's just driving past in his van or whatever.
Right.
But it's like the important thing for consumers is really just that, like, there's a lot of confusion out there, and it's important to be informed.
So we've got the automatic termination ones.
And then borrower requested.
Do they still do the automatic termination loans?
Yeah, it still automatically terminates. I mean, under what's under the law. So it's typically when your loan was originally scheduled to reach 78% loan to value, it comes off.
Okay. So when I got my house and my loan, I didn't have an option to have PMI that automatically fell off, or the last time I refinanced it. I didn't have that option. Now,
it's usually in a disclosure.
That might be because of the amount that I was refinancing compared to the value of the house.
If it's your principal residence, like, it sounds like it's probably covered. So there's a disclosure somewhere that has a date.
Right.
And usually that date's a long ways out.
No, what I'm saying is through my mortgage lender, he said there wasn't an option to have a PMI that can drop off.
Interesting.
So is that might be lender specific?
It might be. I'm sure there's some carve out they might have had, but again,
it's an FHA loan. But
there you go. It's FHA, because instead of having PMI, you're insured by FHA, and they have a weird premium that the premium is like pre-calculated. It's like built into the loan, and it already kind of does some of those things.
And they call it mortgage insurance. They don't necessarily call it PMI.
PMI is private mortgage insurance. So it's like mortgage insurance. Like there's the public, which is all the exceptions. Like those are typically going to be better.
Right.
Depending on, what it is. Like I remember when the Obama administration changed said we were looking at changing some of the PMI thresholds. So one of the PMI companies, their stock like dropped or whatever because they were like, oh crap, we're not going to make whatever the money is, because it's like, they have their formula for how much the premium is.
Right.
And so like when you're shopping between the loans, it's important to know what those costs are, because the private insurance might be cheaper. The other options might be cheaper.
Right. So going back,
there's also lender paid PMI, which is even more fun.
So back to the FHA for a second. Yeah. It's my understanding there's a difference. Mm-hmm. If you do an FHA loan with just 3.5% down, as compared to an FHA loan, mm-hmm. like if you put 10% down, you might mm-hmm. have a different option for when that mortgage insurance, or if it can drop off.
FHA is a little weird. It's not really my wheelhouse. I've mainly dealt with the private stuff. So it's like, I know that it's there. I know it's got like a premium that's real complicated. Like, because like with private mortgage insurance, you have like a premium, and it's like the same premium for like years. And then eventually it might change if you have a longer term loan. But that's kind of like outlined in the certificate itself. Okay. So it's like, it's typically like a cost that's a percentage of that loan balance. So like the higher your balance, the higher your premium.
Okay. So you intrigued me with that lender mortgage insurance.
Lender paid PMI.
What do you know about that?
what that is the lender, instead of giving you PMI and having to follow all these rules about requests and all the things back and forth, the lender basically buys an insurance policy. They tell you at the beginning, basically, we're going to have lender paid mortgage insurance. And then on the date that you would have normally reached the 80%, loan to value, they send you a letter saying, you could potentially save money because your rate has this PMI built into it. And if you refinance, you might save money. And then they're done.
Okay.
So like, from a borrower perspective, like I really like things that go away.
Right.
Like I like knowing what's the cost. I can figure out what's the PMI premium. If I know the date, I can multiply the number of months, and then you can run that trajectory. Like if I pay down my loan faster, what's the potential savings of PMI?
Right.
Not even counting interest savings. There's it gets more complicated.
So this channel is dedicated to maximizing our cash flow. Mm-hmm. So for me, I don't want to have equity locked up in my home. So my preference mm-hmm. is to borrow more than the 80% than mm-hmm. is originally or traditionally done, right?
Yeah.
My preference is to do it 80% with a regular loan or traditional financing, and then a HELOC on top of that. But if I'm in a situation where I don't have that possibility when I first mm-hmm. do it, what would you say? What should I or our listeners or our viewers, what should they look for in order to minimize these PMI costs but maximize our cash flow?
Well, for maximizing the cash flow, the important thing is looking at, like I said, like, if you're getting a loan with lender paid PMI, that's on the loan. That's built into your rate. That's built into the agreement. It's never going away.
That'll be there
what
forever.
It is.
Okay.
So I tend to look at, well, how long would it take for this number to go? And I, maybe run an amort schedule and figure out, okay, where's the 80% date? Where's the 78% date? Because at 80%, that's where you can start requesting for it to come off.
Right.
And then the 78 is typically going to be what it automatically comes off as long as you're current on your payments.
Right.
So I, run the worst case scenario is my advice, having been through the last downturn. If you're in an area where housing prices are going up and up and up and up and up, then, maybe you can get it off sooner, but I don't like to bank on a maybe.
Right.
I like to bank on a certainty. So like for your viewers looking to maximize their cash flow, they can figure that out. Like, maybe even ask, like when you're applying for a loan, they're going to give you quotes, they're going to give you disclosures. Maybe even ask, like some of them might tell, like when I years ago when I was taking like, kind of initiation mortgage calls, this is like before the old, like, you had to have your MLO number and all that. Like people would call in and you just like, you can know the formula. Like if you know the formula, like you can calculate it
Right.
for the premium. Like you might say, well, what's the general formula? And like, they'll tell you what that is, and, or they won't. Never hurts to ask.
Right.
Just like anything else. Like, your lender, while you're trying to get that application, that's when they want your business.
Right. That's your best negotiating position, right?
Yeah, that's your best negotiating position, is like before you've signed the disclosure where you agree that it's not going to come off until 2030 or ever.
Right. So have you dealt with people doing refinancing to drop PMI?
Like not directly, but like I know it happens. Like
Right.
It's a way to do it. Like the big thing is, it's like, okay, you might game it, and you might say, okay, the value of the property's gone up. Well, I can get rid of PMI. But if you're like, well, I'm trying to maximize my cash flow, and boy, would it help to do some kind of cash out refi, pay off some other debts, like
Right.
then you're advantaging both, because like, if you're trying to use the current value to remove PMI, outside of what the law prescribes, your lender might require you to pay for an appraisal anyway. So you're like, okay, well, costs I'm already doing, appraisal.
Right.
Like,
yeah. So if I'm a client who's locked into a loan that has PMI I can't get rid of, then I want to look at probably doing a refinance.
Yeah.
And
or at least like
once the value of the property then increases enough, we're no longer referring back to the original purchase price or the original appraisal, right? We're going to go.
Well, it's from whatever the loan is. So like, it's like, if it's like a new loan, like if it's a new loan,
that's what I'm saying.
They typically do the lower of the two. But if it's an old loan, like if it's like a refi, then they just look at the appraisal they're doing for that refi, for that calculation, because there is no sales price.
Yeah. So in this case, we're talking about doing a refinance.
Yeah.
So they'll go with the new appraised value.
They'll go with whatever they use. So like if some reason the lender uses the old appraisals, then there you are.
Okay. So that might be something you want to check with the lender then. If you're expecting to get out of your PMI because your house has gone up in value, you'll want to make sure your lender is going to go off of a new appraisal.
Yeah.
So you
typically
don't want to get 3 weeks down the road with your lender and then find out that they're not going to base off a new appraisal.
Right. And that's, I don't know how common that is. Like, I'm I'm risk averse, and I would just think as a lender, it would be kind of silly for someone to say, I want to rely on a previous determination for something else, because like, if you did something wrong, like you're now kind of inheriting whatever those sins are.
Right. Yeah.
That's why like typically, like when you refi, like, the title company will sometimes give you a discount on rewriting a title insurance policy for the same person, because they're like, well, if we screwed up, we're already on the hook.
Right.
So, there might be an advantage to that. Like mortgage companies are going to be as creative as they can be. Like, some might be more creative than others.
Right.
Depending on the risks they want to take. PMI is a risk for the lender, because, the more equity someone has in their house, the more likely they are to make the payment, because that's their stake in the house. If you walk into the house and you have no money down, and next thing you know, the next Monday they turn on the sewage treatment plant next door, and you say, gosh, I can't live here, and you just walk away, lender's on the hook. They paid all the money. Like, they're going to have to, they're on the hook. Like they'll still try to come after you to get whatever they can.
Right.
But, their recourse is typically foreclose on the house if you don't pay. So they don't want to do that. And that's, where PMI makes them a little more comfortable.
Right. Now, I may have interrupted you. I recall you saying the number one reason and the number two reason with PMI. Reason?
For getting rid of PMI, there's the automatic, there's the pay down, and then there's like usually like a current value option, and that's depending on who owns your loan.
Okay.
When a lender purchases your loan, they're typically gonna notify you, so you're gonna know who owns your loan, or you call your servicer or write to them, and they'll tell you who owns your loan. And they'll typically, that they're the ones who are setting those guidelines. So it's like, they might say like if it's an investor that's a small investor, they might say, just do what Fannie does. I don't want to have to manage all this. But that's kind of on them for some of these exceptions.
So with private mortgage insurance, it's totally up to the lender what they
for the current
require
outside of what the law prescribes, because there's the automatic and then there's the pay down. So anything outside of that, like that's kind of a let's make a deal situation. And so rather than
have easier requirements as far as what they'll allow clients to get out of doing the PMI.
Right. Like, Fannie Mae, for example, if you make improvements to your house, which is typically something people do right after they move in, they're like, let me add something, let me put in a pool, let me do whatever, Some people say, well, I've increased the value of my home. Well, you didn't pay down the loan. You could have used the money to pay down the loan, but you didn't.
Right.
You didn't reach 78%. Like you didn't reach the date that it has to come off because you didn't time travel. And so what can I do? So Fannie basically says, well, in the first 2 years, because the loan isn't seasoned, we expect a certain loan to value for this appraisal to come in at. So like your value has to improve enough that it's like 70% for example. They'll say if you're at 70%, then we'll get rid of it outside of the requirements of the law. If it's older than that, then they might go with 75.
Yeah. Cool. Well, that was a lot of good information. Was there anything else on your list of things to go over as far as PMI? We may just go with just PMI for this this video. We don't need to necessarily get into anything else. It's a lot of YouTube people like to watch and have a narrow focus on what a video is, so they don't have to dig through a lot of different topics.
Right. I mean, the big thing with PMI is looking at your disclosures and contacting your servicer. I mean, they're typically going to send you like annual disclosures about your PMI, but like you want to be more active than that, because like if, for example, they send you the annual disclosure in January, but you could drop it in February and you waited till the next January. Well, every month that you could have removed PMI and you didn't, that's like money you just gave to an insurance company.
Sure. Yeah, that could be $1,000 that you just.
I mean, depending on the premium. I mean, like if your PMI is like $16, then you probably don't care as much than if it's 100.
Yeah, I think mine's close to 100, if not over. So.
Yeah, if it's 100, like to me, that's a number that's like a real serious. Can I get rid of it number?
Yeah, that's why I want to get rid of it.
And that's why those initial disclosures are so important. And they're in like a big stack of papers. Typically, you might even ask your servicer might just say, hey, I need a copy of it. Can you send it to me? And they'll maybe throw it in an envelope and send it out. Then you've got a new copy here. If they have like secure email delivery, they might do that.
Right.
I'm a big fan of having stuff in my email. Like, I'd probably, if I was doing a new loan with PMI, I would probably take a picture of the disclosure, put it onto the reminder, calculate the dates, and then set myself to remind myself like before that date, and maybe check in like every time you get those disclosures from your mortgage company about removing PMI, like double check with them. Has the law changed? Yeah. Like, has the law changed? Or even just like, how's the weather? I mean, they're not charging you for the phone call. So
yeah, so that's a great tip. So right when you get your loan, find out when you can get rid of the PMI and put a reminder in your calendar right then.
Yeah, exactly.
Take a picture of it. And if you can save a picture in the calendar, even better. But
definitely
put the reminder in there.
Whatever you need to remind yourself, because because of that difference between the 78% and 80, and especially when it's an 80 based on when you pay it down, like a lot of people, like, you mentioned like cash flow, like if you're buying a new house, you're stretching yourself out, getting the higher loan to value, so you don't have to sell your old house beforehand.
Right.
Like once you sell that house, now you've got a lump sum of money. What are you going to do with it? You're going to want to find out, what are my options for getting rid of PMI? Because like for example, your loan, James, you were talking about, your lender says this is just part of your loan forever.
Right.
Well, if you throw the money down on the loan, that's not necessarily going to save you that $100.
Right.
But my cat is.
Who's that?
This is my cat, Lucas. He likes video meetings.
Nice. He looks pretty at home there on your desk.
he is at home on my desk. You know, I spend a fair amount of time on like video calls for work and things. We've been working remotely, which is good while we're all physically distancing.
Yeah.
And there was one point where we're all up there like the Brady Bunch, and he just walks like, and the person speaking stops the meeting. Is that your cat?
Oh, funny.
Yes, it is. Yes, it is my cat. So hopefully that's helpful. You know, I wish I could just say like, here's all of the answers right here. Here's a 1-page little, like, here's when it's gone button, but really that's not the case. The just important part is just like, you know, planning ahead, making sure you know what you're getting into. So that way, you know, you're not surprised.
Yeah, no, I appreciate that, because, you know, I'm not, I'm on the realtor end of it, and I don't deal with the financing. So it's just whatever my personal experience has been. And I was unaware that the mortgage insurance that I had was different than PMI, that it wasn't.
Yeah. There's a lot of different ways that are there. Just
than
like,
lender's
you know,
insurance. So yeah, I appreciate that. I think you provided some value here to our viewers. So thank you very much.
Yeah. No, it's exciting. I'm glad to help. You know, hopefully, you know, maybe I saved somebody like 5 minutes of a 40-minute phone call.
Yeah.
You know, like, but the big thing really is just, you know, planning ahead, like being very familiar with your loan documents, being very familiar with what you're getting into. When the CFPB rolled out some of their, you know, newer disclosure rules a few years ago, they used the phrase "know before you owe," and that's like what's really important, is knowing like what you're getting into. And so, you know, there's a lot of requirements on disclosures to try to make it as simple as possible, but even then it's still complicated. So try to make it as simple as possible, so you're not in the middle of a discussion with your spouse about $100 a month versus like, you know, when you're shopping loans is the best time to try to find out all those facts in advance.
Yeah. Well, thank you very much. I appreciate you taking some time out of your day. I know you probably just got off work, so we appreciate you helping us out. And I look forward. We'll have to have you on again sometime.
It'd be fun. You know, like I said, I'm not here representing anything, you know, in relationship to my employer. I'm just here as a guy who, you know, spent some time working in mortgage servicing and knows a couple things about a few laws.
Awesome. Well, I appreciate that. Yeah, you know, I do this channel because my main focus is to put information out there to help people save money, eliminate debt, maximize their cash flow, and I don't get paid for any of this. So
well, I mean, and it's, you know, and it's just good to stay connected. I mean, like right now, a lot of people are looking at like their bills. A lot of, you know, lenders are probably working really hard to try to help borrowers during this time. So like if you're somebody that's looking at your bills, looking at your cash flow, you know, call up your mortgage lender. You know, that's the biggest bill in your monthly budget. That's your biggest bill, hopefully.
Yeah.
And if that's your biggest bill, like, see if, you know, what help can they offer, you know, like, you know, or, you know, even if you're not having problems, call them up, find out, you know, can I refi? Can I get a better deal than what I got?
We'll have to talk about this in another video. But there's things that people can do just by calling their lenders and getting some type of relief. You know, sometimes you can get a streamline refinance where you just refinance through the same lender.
That's just usually a buzzword.
There's something I was looking at where you can refinance through your same current lender, and I don't know. Just supposed to be
there's like a VA version, and then there's like some other stuff. Usually it's just like, you know, they might have some different requirements, but to me it's just like, you know, it's just like talking about it being fast. Rather than necessarily it being fast. And that's not a condemnation on anybody. It's, you know, everything takes longer than you think. You know, if you're applying at the same time as, you know, thousands of other people, like, you know, if it's above what's projected, you're probably going to wait. It's like, you as a realtor, are more real estate transactions in the summer? Like, you know, people are moving between school years, spring and summer. And so like, you know, what does that mean? That means like, you know, everybody's closing around the same time. Well, that means like everybody's like, you know, if they have an ARM loan, those ARM loans all start to adjust around the same time, you know, like, and And so it becomes like this kind of like, cyclical. There's no great time of the year that I can just say February 28th, that's the day to call or whatever. Like, I wish I could.
Yeah.
So it's just a matter of like, finding out, like with any lender, like, is there something they can do to help? Is there something they want to do to help? Like, are they reaching out right now? Are they, taking precautions? Like, about like, if you, they have a physical office that you go into, or is it safe like right now during a pandemic? Or do they recommend you calling on the phone, or is there like a website?
Yeah.
I remember a few years ago, I think JD Power or someone did like a, some kind of study, and it was like for like questions about an existing mortgage, it was like half of the people that called and tried to find the answer online. So like a video like this might not give someone like the answer that's specific to their loan, but it might help them with help give them the right question to ask. So that way they can do it. It's like, probably the quickest answer I can think of is when someone's like, okay, what's my balance on my loan? Because I need that for my realtor. You give the realtor, what's your balance? And they're like, well, did you get a payoff quote? Then you got to call back, get a payoff quote. They're like, well, I need it sent to a third party. The lender might say, well, I might want some other additional things to send it to a third party. So now you've made 3 phone calls versus like the one because of that lack of communication.
Yeah. Yeah, that's exactly right. That's where I like to use YouTube also. It's oftentimes you'll find the answer on YouTube, and it might be quicker than doing the phone.
Yeah. Even just like doing some of the, kind of look up for this coming in, there's still so many questions out there. Like, there were some forums that used to exist that were, for finance folks, and like people were just like railing all about PMI. And I remember like looking at it once going like, it doesn't really work that way. You need to call your servicer. Because there's just a lot of misconceptions. There's a lot of rules. There's a lot of regs. It's not a condemnation on whether there should be rules or regs. I tend to believe in simplicity. Like, can I explain it to the cat? And if the cat gets it, then we're probably good. And if you have to ask if something's okay, then it's probably not.
She's stuck, or he's stuck.
He's stuck. Yeah. Tried to come through the hoop here.
All right. Well, I appreciate that.
Yeah.
Won't take any more of your time today. Thanks for joining us.
Lots of fun. Yeah, lots of fun.